All right. Good evening, everybody. Welcome to another live Think Realty webinar. Think Realty is the voice for all things real estate investing. Please visit thinkrealty.com to learn more about how you can use real estate to create your legacy, create the life that you want with time, wealth, and purpose. My name is Kurt Power, sales manager for Think Realty. Very excited tonight. We got my good friend Matthew Bowles here from Maverick Investor Group out in Las Vegas. And he's got a great presentation tonight. He's going to let you know everything you need to know about buying real rental properties in 2023 with an update on the latest market trends. But first, a couple quick items, a little housekeeping here for Think Realty I want to alert you guys to. And I'll leverage the chat box for this portion of it, the links that I'm going to send. I ask you that when we actually have questions for Matthew, let's use the actual Q&A function. I find it's just a bit more organized for it, but for the purposes of what I have for Think Realty, I'll use the chat. Think Realty memberships, guys, they are free. They cost you literally nothing, and they get you tons of access to content like this webinar, like Think Realty magazine, like our podcast. So please go to thinkrealty.com, get your free membership, and start learning and preparing yourself for the coming year and beyond. And what we do at Think Realty is we educate through our partnerships with people like Maverick Investor Group on how you can become a professional real estate investor and live the life that you want. But part of what we do is we do that with our in-person conferences. And we have a great conference coming up in Houston, which is where I'm from, March 23rd and 24th at the Embassy Suites and in the Energy Corridor. Guys, this is 2 days of networking with your peers, industry experts, deal flow, and finding out what the best investment strategies are for 2023, as well as what markets you want to be in and what asset classes are the most recession resistant. Recession is the big buzzword in 2023, guys. So you might as well prepare yourselves to know now, where are the deals? Who do you want to be doing deals with? And what are those assets that you want to use for diversification in your portfolio? So make sure you check us out, Think Realty Conference and Expo. I'll put a link in the chat so you guys can get your tickets for that. We also have it in a recording. So if you can't be there in person, purchasing a ticket will actually get you the recording of it. So you're not going to miss it. Whether you can be there in person, do not miss out. And another great resource is our Think Realty podcast. It's available on platforms like Stitcher, iTunes, Pandora, really anywhere that you get your podcast. We put out new episodes daily. So again, equip yourself with the knowledge, the tools, the resources to be successful as a real estate investor. Continue to grow your knowledge, grow your network, and ultimately grow your net worth. So again, I'll put that in the chat box for you, but I want to introduce again, Matthew Bowles from Maverick Investor Group. Matthew, appreciate you being here tonight. I've been looking forward to this for a while. We started talking back in November. I had strep throat, the flu, all at the same time, as well as a severe sinus infection, but we got through that. And I'm pleased that we were able to get this organized. So thanks for being here tonight, man.
Kurt, thanks so much for having me, man. Such a great and exciting night to be with you in the community, man.
Absolutely. Well, I am going to mute myself. I'm going to stop my video, so they're going to be paying attention to you. I'm going to turn the command over to you so that you can start showing us your presentation. I really look forward to it. Can't say it enough, guys. Use the Q&A function here. Let's get some good conversation going. Let's get some good ideas. And most importantly, let's get this presentation going. Take it away, Matthew.
Awesome. Thanks, Kurt. Well, I have been a Think Realty subscriber myself since the very founding of the magazine. So I've been a longtime member of this community. Super excited to be here tonight, sharing with you and unpacking some of the latest data to try to understand what's going on in the 2023 rental property market and how can you make the most strategic decisions about your real estate investing this year. So let's just kick this off, though. I want to make sure that we can interact with each other. We're going to save the questions for the end of the webinar in terms of going through your questions, because I'll probably cover a lot of stuff in the webinar, but we'd love to just chat with you guys and connect a little bit here at the beginning. So if you can just type into the chat box, just so that I can see that we're communicating, just let me know where you're tuning in from tonight. And also let me know if you have already purchased, if you already own an out-of-state rental property, or if you do not yet own an out-of-state rental property. So go ahead and just type into the chat box. Let me know that. Do you own an out-of-state rental property yet or not? And where are you tuning in from tonight? And then hopefully I can just see your answers flow through there, and we can chat with each other as I go through some of this. So for folks that are have not encountered Maverick Investor Group or me before, I'm just going to do a real brief intro before we dive into the content and the education tonight, and just give you a little bit of background about me and my company. So I am one of the founders of Maverick Investor Group. We have been running our company for 15 years now. You may have seen us featured on a lot of the different real estate investing press over the years, or the different media. And we've been doing one thing and one thing only since 2007, which is helping you buy turnkey rental properties in the most investor advantaged US real estate markets, regardless of where you live. So that is our very specific niche specialty that we do. We've worked with a lot of people from the Think Realty community over the years to help them do that. And basically, when we built our business model, the way that Maverick Investor Group works is that we said, okay, we want to create these pillars of value for real estate investors. So this was the business model that we created. Number one, to help our clients buy in the most investor advantaged US real estate markets, regardless of where they happen to live. Number two, be able to buy turnkey rental properties, which are either brand new or fully renovated and already have tenants in place and local property management before you close, right? So you're closing on a performing property, leapfrogging over all the upfront risk of stabilizing the property. And then you just cash flow from day one. And then you don't have the headaches of being the landlord or the rehabber, right? Those are the types of clients that like to work with Maverick. They like all the benefits of owning the deeded real estate without the headaches of having to deal with the tenants, right? Or having to oversee the renovations. So those are who our clients are. And then we help you to access off-market properties that are not available to the general public. And finally, have the deals come to you so that you don't have to spend your time out there looking for them. That's what we do, right? We are identifying these most investor advantaged markets. We're bringing these deals, sourcing them, bringing them to you so that you can just evaluate them, conduct your due diligence, and decide if it's the right fit for you. But you don't have to spend all your time finding the deals, right? So that's pretty much how Maverick Investor Group operates. We've been doing the same thing for 15 years now. We have a lot of clients that have been building their rental property portfolio through Maverick for over a decade. We've been helping people to buy and diversify across markets. We work in a lot of different markets around the United States because the best markets change over time. And we are based on long-term relationships with our clients, right? So that's who we are. That's what we do. And that brings us to the educational portion of tonight's webinar. What I want to cover tonight, we get a lot of questions from our clients. And so I put together this presentation for you with a lot of the latest data that is out to answer some of the most pressing questions that people have and explain a lot of things where there's confusion in the market today. So first of all, we're going to talk about why an imminent housing crash is not likely to happen. We're going to talk about the benefits of today's mortgage rates for rental property owners. We're going to talk about why the advantages of single-family rental properties are actually turbocharged in 2023 more than they usually are. We're going to then talk about how to identify the recession-resilient real estate markets, and then talk about 4 reasons to buy turnkey rental properties, how to conduct your due diligence if you're buying out of state. And then I'm going to show you the market where I just bought a rental property. I'll show you the pictures, the exact market where it is, and the financial numbers of the property that I just bought myself for my own personal portfolio. And then we're going to finally talk about the number one mistake that real estate investors are making right now and how to avoid that. Okay, so with that, we're going to rock through this tonight here, and then we'll take your live Q&A at the end of this session. But go ahead and type into the chat box and let me know, if you haven't already, where you are tuning in from tonight. I see we got Rochester is in the house, Massachusetts. We got Maryland. I guess the chat is disabled, so people are dropping this stuff into the Q&A. Sorry about that, guys. I didn't know the chat was disabled, but you can feel free to drop it into the Q&A. But welcome Ron and Raymond and Peju and everybody else who's contributing here. Awesome to be with all of you tonight. Super excited for this. So let's jump into the presentation here. Okay, so no signs of an imminent housing crash in 2023. Let's unpack the actual data about why that's the case, because there's a lot of fear mongering that's going on around what's going to happen. There's going to be a big housing collapse, all of this other kind of stuff. And let's sort of look at what the actual data is says. Okay. Sorry about that. I just skipped ahead here. Let me just try to clear this screen. 1 second. Sorry. Okay. So the screen is going the wrong way. Okay. Sorry, guys. Having a small technical problem. Okay. So the main thing to understand is that right now, homeowners are simply not distressed. Okay. Distressed homeowners are a key ingredient to a housing crash, right? People need to be incentivized to sell their properties or forced to sell their properties at lower and lower prices. And it's just simply not the case in today's market. Okay. 97% of mortgages are performing. Only 3% of mortgages are delinquent today, right? Only 0.55%, about 0.5% of home sales are foreclosures. The average credit score of a mortgage borrower today is 728. That is an excellent credit score. So the mortgages are being taken by highly qualified buyers. Now, 37% of properties have no mortgage at all. They are owned free and clear. Okay. So of the properties that actually do have a mortgage, 98% of those have positive equity, and the average loan to value is 44%. So that means the average homeowner has 56% equity in their home, and that comes out to an average of $300,000 is the average amount of equity that the average homeowner currently has in their home. It's a record all-time high, okay? So homeowners are simply not distressed. That is a really important first piece of it. The second piece of it is that inventory is still incredibly low. It is starting to tick up, but it is still about half of what is considered a healthy, balanced market. Okay, so about 1.5 million properties listings for sale is a healthy, balanced market. You can see on the left-hand side there, about 1.5 million back in 2017. Today, there's about 750,000 listings available for sale in the market. That is about half of what is considered a healthy, balanced market. So there is still a severe shortage of properties, and when you have a really low supply that's much lower than demand, that does not cause housing prices to crash. So that the lack of supply combined with the performance of the mortgages and the amount of equity that people have in their houses shows no indication that a crash in the market is imminent. Now, housing prices are obviously not going to go up forever at the rates that they've been going the last couple of years. Certainly, there'll be some leveling off of home prices and some slowing of appreciation and things of that nature. That always happens. But a housing crash, there's just no signs of that. Okay. Now, the other thing that we get a lot of questions about is the rising mortgage rates. Okay. So what I want to break down here is the benefits of today's mortgage rates for rental property owners. All right. First of all, mortgage rates are still at historically low levels. They're certainly higher than they were 2 years ago. That's for sure. But today's mortgage rates, historically speaking, are still very low. Now, since they have risen over the last 2 years, a couple of important things to understand about that. Rising mortgage rates correspond with increased rental demand. Okay. Homeowners that were just about to be able to buy an entry-level home at the entry-level price point now are priced out of that. They cannot buy that entry-level home because the mortgage payment is too expensive. So guess what? They have become renters. They're pushed back into the rental pool. That means more renters. That means higher rental demand. And that means upward pressure on rents. And that benefits rental property owners. Okay. Also, rising mortgage rates have historically corresponded with rising home prices. In fact, if you look, all 6 times that mortgage rates have risen in the last, since 1994, every single one of those 6 times that mortgage rates have risen, home prices also rose. Okay. Now, why would that be the case? Well, if homeowners have a rate locked in at, say, 3%, and they realize that if they were to sell their home and buy a new home, even if the home was the same price as their current home, their mortgage would be significantly more expensive for the same home, right? The same value home. So what they're going to do is they're going to be incentivized to hang on to that mortgage at all costs, which means the only way you can hang on to your mortgage, right, is not sell the home. And so it actually incentivizes people to keep their homes off the market. That further reduces supply, and that further contributes to driving home prices up. Okay. And finally, the real inflation adjusted mortgage rates are actually lower today than they were in 2021. Okay. These are very important concepts to understand. What you need to do is take your mortgage rate, but then subtract the rate of inflation to get the inflation adjusted mortgage rate. And if you do that, you will find that the real inflation adjusted mortgage rates today are actually lower than they were 2 years ago. All right. So let's take a look at the historical mortgage rates here. All right. You can see where we are. We actually just had a dip in the mortgage rates, but you can see there, if you take that line all the way across historically, yes, they're higher than they were 2 years ago, but historically speaking, they are still very low. All right. And then if we look at the inflation adjustment, okay, let's say that in January of 2021, you were able to get a mortgage on a rental property for, call it 4%, right? But the rate of inflation was only 1.4% in January of 2021. Right. So when you subtract the rate of inflation from your mortgage rate, your real inflation adjusted mortgage rate was about 2.6% 2 years ago. Right now, let's say for your rental property mortgage rate, let's say it's 7%, but the rate of inflation is 6.5%. So when you subtract that, your real inflation adjusted mortgage rate is only 0.5%, significantly lower than the 2.6% it was just 2 years ago. Okay, so let's put this together with some of the other pieces of the puzzle to fully understand the picture of today's market and understand why the advantages of owning rental property are actually being turbocharged in 2023. The first thing we need to do is understand what are the normal advantages of owning a rental property, right? Why are we buying rental properties as opposed to other asset classes? Okay, one of the main reasons is that you get 5 profit centers when you buy and hold a rental property, not flip, but hold a rental property, which is very different from other asset classes, right? When you buy a stock, typically you have 1 profit center, which is that maybe it'll go up in value. And all you can do is hope and pray that it does. If it does, great. You got to then sell it. Then you got to pay a capital gains tax. Then you got to hope that whatever's left over is higher than the rate of inflation in order to actually make money in real dollars. If the stock, on the other hand, goes down, you're pretty much entirely out of luck, right? But 1 profit center, that's it. Sometimes there can be a second one if it's a dividend paying stock, for example. But in real estate, when you buy and hold rental property, you've got 5 profit centers. You've got your passive cash flow that comes in. Your tenant's rent covers all of your expenses, and then has positive cash flow coming into your bank account every month if you buy the property right. Okay. Then you've got the market appreciation, right? The home goes up in value. You'll build equity that way. But you've also got the tenant paying down your mortgage, right? Your tenant's rent covers your whole mortgage, including your principal pay down. So you're building equity that way, even if the market doesn't go up in value, right? You hold this property for 30 years. If the market doesn't go up in value a single dollar in 30 years, never happened in the history of real estate, but let's say it happens to you, you would still have built equity because your tenant would have paid off your entire mortgage by then and you own it free and clear. It's a separate profit center, right? Then you have your tax benefits, right? The government wants to incentivize you to buy and hold rental property and offer it to lease for your fellow citizens, provide housing for your fellow citizens so that they don't have to do it. And if you're willing to do that, they will heavily incentivize you with tax benefits. So they're going to allow you to depreciate the structure of your property, even if it's going up in value. And when you go to sell your property, they're going to allow you to do a 1031 exchange, which means if you reinvest the proceeds into like-kind properties and you buy more properties with the proceeds of that sale, you can indefinitely defer your depreciation recapture and your capital gains tax on that property. And you can do that all the way until death, at which point your heirs inherit the property, the basis resets, and nobody ever owes that capital gains tax, right? And finally, this is probably the least understood of the profit centers of holding rental property, but you can actually profit from inflation, okay? Because home prices rise with inflation, rents also rise with inflation, and if you have taken out a 30-year fixed rate mortgage, you have borrowed that money in today's real dollars, but you are paying the bank back in future diminished nominal dollars that are worth less than the ones that you borrowed. Okay, so you're actually profiting from inflation because it is debasing your debt, right? So normally, if you have your money sitting in a savings account, inflation is super insidious and it's just eating away at your buying power, right? $100,000 in the bank a year later is worth, $93,000, right? That's the buying power. It still says $100,000 there in the bank, but you can only buy $93,000 worth of stuff with it, right? Because inflation has eaten away at your buying power. On the other hand, if you put that money into a property, all of a sudden now you're on the other side of the inflation equation and your home prices are going up with inflation, your rents are going up, and it's debasing your debt instead of debasing your wealth, okay? So buying and holding rental properties, those are your 5 profit centers. Real estate is also the most debt-favored asset class, right? You can get a mortgage to buy the property, use the bank's money to acquire most of your property. But even if you only put down 20%, you get 100% of the appreciation, right? So let's say that the home prices appreciation cools down and the market, instead of going up 10% or 15% or 20% a year, let's say it only goes up 5% a year, right? Which is about the historical average, 4%, 5% a year, something like that, right? Let's say it just goes up 5% a year. Well, if you bought a $100,000 property and it went up 5%, it went up to $105,000. But if you only put down 20% on that property and you've only put down 20 grand and it went up 5 grand, that is a 25% return on the money that you invested with simply a 5% appreciation, right? So that is the benefit of financial leverage. And you can get that today. And while you're getting the leverage, you're also borrowing that money in real dollars and paying it back in dollars that are worth less than the one that you borrowed and profiting from that inflation. Okay. So the official rate of inflation is now 6.5%, right? That's the latest official rate for the Consumer Price Index report that recently came out, right? From 2010 to 2020, the rate of inflation averaged 2% a year. Now it is 6.5% a year. That is more than 3 times the rate of inflation this year, okay? And higher inflation, as we just discussed, equals higher profit for the owners of rental properties, okay? So that's why this year, the inflation profiting benefit is significantly greater than it was 2 years ago. All right. And then it's important to understand that there is still upward pressure on home prices, right? There is increasing demand for new household formation, right? The age demographic of people that are at that first-time home buyer age is incredibly high in the United States right now, but there is still a supply constraint of available homes, both existing resale homes and new construction homes. Both of them have limited supply. We've already discussed about resale homes, how homeowners that are living in them are not incentivized to sell those homes because they're going to lose their mortgage and those low rates. So they are keeping those homes off the market. And then new construction with the high interest rates, the builders do not make as much profit because the interest rates are higher today. So what they're going to do is they're going to want to build very expensive homes, custom homes, high-end luxury homes, because they get bigger margins on those homes. They are less incentivized to build those entry-level homes. So in that space particularly, there is still an incredible shortage of homes. And as we discussed, rising mortgage rates usually further constrain supply. right? Because homeowners are going to keep those properties off the markets. Now, let's take a look at rents. Okay, rents are soaring at all-time high in terms of increasing, in terms of how much they're increasing. Normally, rents might go up maybe 3% a year. You kind of renew your lease, raise the rent about 3%. Last year, rents increased 12%. One tenant moves out, the next tenant moves in. The average bump in the rent was 12%, according to the Bureau of Labor Statistics. All right. And vacancy is at a historic low. It is at the lowest level of the last 35 years. Take a look at the historical graph of the vacancy. Okay, in the United States, there we are on the right. As you can see, historic lows. All of that benefits the rental property owner at a very unique historical level this particular year. Okay, so those are a lot of the macro dynamics that are going on in today's market. What I want to do now is talk about how to identify where to buy. Okay, what are the recession resilient markets as we approach a recession in 2023, whether it's official or it's not official or whatever you want to call it, right? In today's economic environment, whatever language you want to use to describe it, what real estate markets are going to be recession resilient and are going to be the most strategic ones for you to buy in. Okay, so you can take the maximum benefits of all the stuff that we've been talking about. All right, so let's take a look at some of the ways that we think about this. And we start off with understanding demand drivers. Okay, so we're talking about looking for markets that have things like job growth, population influx, lower than average unemployment, a diversified economy, increasing per capita personal income, low cost of living, revitalization projects going on in the market, right? These types of things help to sustain markets through a recession. Okay. Now, if we start to look then after those macroeconomic indicators, we then start to look at, well, what are the real estate fundamentals of this market, right? A very high level metric, which is a good one to start with, is the price to rent ratio. Okay. So this is a very high level metric, but it's important, right? Because the price to rent ratio in certain markets is going to give you it's going to be an easy way to immediately reject some markets, right? Where there's crazy expensive houses and not nearly enough rent to make it sense to cover those expenses, right? So we'll use this rent to value ratio, the purchase price divided by the monthly gross scheduled rent. So if you have, let's say, a $500,000 property that rents for $2,500, well, you divide that and the RV ratio is 0.5. On the other hand, if you have a $100,000 property and it rents for $1,000, the RV ratio is 1%. Okay. So that's pretty simple. But it's a high level metric, and we need to go lower than that and deeper than that and start looking at the expenses associated with the property because they vary by market, right? So let's go to the next level metric, which is the capitalization rate, where you take your net operating income and you divide that by the purchase price. Now we're taking into account, okay, the rent, but we're also taking into account the property taxes, the insurance, the property management fee, if there's a homeowner association fee or any owner paid utilities or landscaping or any of that kind of stuff, plus a vacancy and maintenance estimate, right? All of that should be taken into account as expenses, subtracted from the gross rent. And now you take that annual number and divide it by your purchase price, and now you're getting a cap rate. Okay. Very helpful to do that. Why? Because those expenses can vary greatly by market. So this is why the price to rent ratio is not sufficient by itself, and why there is often some very misleading stuff with people that lean too heavily on the price to rent ratio. So some people might say, oh, there's a 1% rule. You should look for the rent to be 1% of the purchase price. Not a sufficient metric. Let's talk about why. Property X, let's say, is 100,000. It rents for $1,000. Property Y is 100,000. It rents for only $900. Which property would you take? Well, looking only at this, you probably would take property X, right? Because it has the better price to rent ratio. But what if I told you that property X was in the state of New Jersey and the property Y was in the state of Alabama? And as a result of that, the property taxes were radically different. Okay. One of them has property taxes that are $2,490 a year, and one of them has property taxes that are $410 a year. Massive difference, right? So everything else being the same, percentage wise, percentage of property management, maintenance, and vacancy and insurance, everything else the same, just the property tax expense is different. And what does that come out with? The property that seemed to have the better price to rent ratio only comes out to a 6.2% cap rate, whereas the property that seemed to have the less advantageous price to rent ratio comes out to a cap rate of 7.3%. Clearly the better performing option, right? So that's why it's important to go that next level deeper when you're looking at investor advantage markets to fully understand that. Okay. The other thing we want to understand is property cycles. Okay. So I told you we've been doing this for 15 years, right? And over those years, we have had a lot of different real estate markets we've been involved in, and different real estate markets have been advantageous at different times, right? So back in 2011, our most popular market was Phoenix. 2012, it was Atlanta. 2013, it was Houston. I could keep going on. 2014, it was Dallas, right? I mean, I could keep going all the way up and tell you what our most popular market was each year. But those markets are no longer our most popular markets. And the reason is because they're less advantageous to buy in today because of this process of yield compression. So the home prices went up so much in those markets and the rents did not keep pace with the home prices. So now you'd be paying a lot more for the house, but not getting a proportionally more rent, right? And so that has compressed the yields, it has lowered the cap rates, and has made those markets much less advantageous now than they were a year ago. So you have to understand where these properties markets are in their property cycle, right? So for example, here are two graphs. One is for Phoenix and one is for Indianapolis. And that gray line there is the Great Recession that happened in 2008, 2009. And you can see what happened in Phoenix, Arizona, and how that was this massive roller coaster downswing versus in Indianapolis, where it was just kind of like, varied, maybe wavered about 7% or so, didn't do anything too crazy during the Great Recession. This is a recession resilient market. It does not go crashing down through the floor. It's able to weather that very much because it has a lot of those factors that we discussed earlier. Okay. So those are some of the things that we look at when identifying recession resilient markets and where to buy in a property, a period of the property cycle like we're in today. Okay. Now, the other thing that's really important is why to buy turnkey rental properties. Okay. The first one is the really, really, really important distinction between a real estate investor and a landlord, right? A landlord deals with tenants, toilets, and trash. A real estate investor makes decisions and cashes checks, right? Those are our clients, right? Those are the types of people that value their own time. They don't want to be doing the rehabs and overseeing them and creating a job for themselves and all that. They don't want to be doing the landlord job and receiving calls from the tenant and handling the maintenance. They want professionals to be doing all of that for them, so that they can get the benefits of owning the deeded real estate without the headaches, right? Second reason is dramatic risk mitigation. Let somebody else absorb the upfront risk of acquiring the asset, pricing the rehab, managing the reservation, borrowing the hard money, absorbing the holding costs when the renovation takes longer than expected, absorbing the upfront vacancy costs when it takes longer to place the tenant than expected. You just come in, evaluate the deal, conduct your due diligence, and then close on a performing cash flowing property that puts money into your bank account from day one, right? Number three, you get to leverage the economies of scale of professional turnkey companies, right? So instead of trying to do this all yourself and negotiate a deal and hire a contractor and all this other kind of stuff, these professional companies that do it at scale, they are paying all cash for many deals at the same time. They're getting access to better deals. They are buying their materials in bulk. They're getting everything for less money. They're running professional teams of construction crews. They're getting an economy of scale there, and you get to benefit and leverage all of that for yourself. And finally, you get to remove geographic restrictions and buy in the best markets, regardless of where you live, because you don't have to be overseeing those renovations and dealing with the tenants and all of that kind of stuff. You get to buy in the most advantageous markets, the most recession resilient markets, whether or not you happen to live in those markets, right? So those are the turnkey advantages. Now, some of the questions that we get from people are, well, if I'm buying out of state, how would I conduct my due diligence on the property? Very important question. And the answer is actually pretty simple. The answer is the exact same way that you should be conducting your due diligence, even if you are buying down the street from your primary residence, right? Unless you personally are a home inspector, you're going to be hiring a professional one, right? And you're also going to be using other independent third-party resources to evaluate the deal, right? So you're going to, first of all, verify your operating expenses, verify your property taxes, verify your insurance, verify your property management rate, all of that kind of stuff, right? Then you're going to verify your tenant's rent, that they have signed a lease, they are paying what you understand that they're paying. Then you're going to verify independently with the property managers that the rent that your tenant's paying is in fact the market rent. And if that tenant were to move out, they could reasonably, reliably release it in about 30 to 45 days for about the same rent. Okay. Then you can evaluate the risk of the particular micro market or neighborhood where you're buying. And there are services where you can do this. I've got a link there. If folks are interested, there's a service called RentFax, which is the one that a lot of our clients use. That's an affiliate link there, which will give you a free RentFax report. Your first one is entirely free for any address. You can type in any property address in the US, and it will give you the rent range. It will give you talk about the quality of the school district, the crime rate, all of these different things. And then it will come up with the risk factor and all of this kind of stuff, a full sort of assessment of the micro market, right? The neighborhood, the address level of the property, right? So you can do that anywhere in the United States through a service like RentFax. And then I always tell people to interview multiple property management companies, right? Like they don't care. They have no vested interest in you buying a particular property. You could just call them up and say, hey, I'm thinking about buying this property. If I were to give it to you to rent, how much rental demand would you have for this particular area, this particular type of property, right? If it were to go vacant, how quickly do you think you could fill it? Or maybe you're deciding between 2 or 3 properties and you say, listen, if I was to give you any one of these 3 properties, which one would you be most excited about managing? Which one do you think you could rent the quickest? Would be the most demand for it, right? And by that process, now you're getting third-party professional opinion from local experts there, and that can help you to do your due diligence and make sure that you have a winner for your property. And then finally, of course, you're going to order a professional home inspection, have that inspector go in. They work for you, not for the seller, and inspect that property and make sure it's in the condition that you want. Have the seller create a punch list and fix some items at their own expense before you close. And then, of course, if you're getting financing, your bank is going to send in an appraiser to do an appraisal, because the bank is not going to lend you money on a property if it's worth any less than what you're paying for it. So they're going to want to make sure that their own investment is a good one. So you're definitely going to get appraised. So, we provide our clients resources and support in conducting this, but we make sure they conduct it independently. And so they understand that that they're using third-party professionals, not Maverick, not the seller, but that's really the way that you conduct out-of-state due diligence. And with that, let me show you guys the property that I just bought a few months ago in what was our most popular market of 2022. St. Louis, Missouri is where I bought a property. So let me just show you, I want to give you an example of a recession resilient market. St. Louis is definitely that. And I want to show you why this market is so uniquely advantageous, why I chose to buy a property here for my personal portfolio recently. So St. Louis, first of all, just with the economic indicators, right? It's home to 8 Fortune 500 companies. The GDP has increased 29% in the last decade. It's now over 170 billion, but the cost of living is 12% below the national average, right? Top 10 most competitive MSAs to do business, ranked top 10 large American cities of the future. But the unemployment rate is significantly below the national average, right? St. Louis is also the #1 market for home affordability in terms of people's mortgage payments as a percentage of their income. Okay. So here you can see, as a percentage of their income, people in St. Louis, their mortgage payments are only 24.5% of their income. Okay. Lowest in the country among large MSAs. So these are the types of things that we look for. St. Louis also has rising per capita personal income. That is important because that means you can raise your rent every year and people can afford to pay a higher rent every year. You can sell your house down the road for more than you paid for it, and people can afford to pay more than you paid for it to buy it from you, right? Home price appreciation in St. Louis last year was 13%. Okay. And I will now show you the exact property that I bought. I'm going to show you the pictures of it, and I will show you the financials and what that looks like. So this is the property here. By the way, I bought this right off the Maverick Investor Group website. So I literally bought this exactly the same way that every single one of our clients does. It was on our website. I just reserved it through the website, and I went through the buying process. So I bought this exactly the same way that every Maverick client buys their property. $102,000 property, rents for $1,000. It's about a 3-bed, 1.5 bath. This is what the interior looks like. Okay. So these are what the interior fully renovated finishes look like. This was all completed before I closed on the property. This is a $102,000 property. Okay. This is what the interior finishes look like. And then these are what the numbers are on my property. Okay. Those are my actual property taxes, insurance. That's the property management fee that I pay. I'm assuming an estimate for maintenance and vacancy. Now, my tenant, moved in right before I closed. They're on a 12-month lease. The property was just renovated. I'm not expecting any vacancy or maintenance in the first year or so, but eventually I know if I hold this property for 15 years down the road, eventually I'll have some maintenance and vacancy. So I'm just factoring it in. I'm just assuming, about 12% combined for maintenance and vacancy. But all of the capital expense items in this property have been replaced. Brand new roof, new HVAC system, new hot water heater, everything replaced, fully renovated, brand new. And the whole thing just for $102,000. And again, when I closed on this, all those renovations were completed. They had already been inspected. They had already been punched out by the seller based on our punch list agreement. The tenant had already moved in. I closed on this, and then boom, just been collecting the rent checks every single month. And this one has about a 7.2% cap rate, as you can see there. Now, if you are interested in viewing similar properties to the one that I bought, there are many of them available that you can check out on our website. Again, I told you it's exactly how I bought mine. Just went to maverickinvestorgroup.com/STL. I picked out one of them. I reserved it on the website, and then I moved forward on it. So if you are interested in checking out St. Louis inventory like the one that I bought, that's how you can do it. maverickinvestorgroup.com/STL. When you go to that website, though, you're going to have to log in or create an account in order to see the full itemized financials, right? Otherwise, you're just going to see thumbnails and you're not going to be able to reserve it. You need to be logged in to be able to see the full financials and also to reserve. And keep in mind that what you're going to see there are mostly pre-renovated pictures because you're reserving it and putting it under contract before the renovations are fully done. But their completed renovations are a condition of closing. So you'll have that in your contract, and you don't close on the property until the renovations are done. So if you see pre-renovated pictures there, that's why. That's not the condition that you're buying it in. You're putting it under contract. The contract will say fully renovated as condition of closing. Okay. So with that, I want to sort of bring this last part and really emphasize the #1 mistake that I see real estate investors making right now in today's market: waiting to buy. They're losing money by not buying. The real estate market is on the move right now. all of the different conditions that are coalescing have turbocharged the advantages of buying rental properties in very unique ways. And a lot of those ways people don't understand, right? People don't understand how inflation benefits rental property owners, how uniquely high the inflation is right now, and how you profit from that when you own rental properties, right? And all the other dynamics that we've talked about tonight, right? About why it is so advantageous to buy. And a lot of people are just sitting on the sidelines, they're waiting. And the reality is that as long as you buy right, you should make your money when you buy, and you don't need to speculate on what exactly is the housing market going to do, because it doesn't really matter if you're buying and holding for the long term, right? As long as you buy based on real estate fundamentals, you're going to cash flow because your rent is covering all your expenses and it has a positive cash flow. Then it doesn't matter what the real estate market does tomorrow or 6 months from now or 2 years from now or whatever. If you say, I'm going to buy this and hold it for 10 to 15 years, it doesn't matter what the housing market's doing. You're collecting your cash flow every month. Your tenant's paying down your mortgage every month. You're building equity that way, no matter what the housing market does. You're taking your tax benefits every single year. So, you're profiting from inflation. All these things are going on regardless of what the housing market is doing, right? And with the mortgages, most people think the mortgages are going to start to go down, right? As inflation goes down and recession comes upon us, mortgage rates are eventually going to start to go down as well. And when they do, you can refinance and lock in a lower mortgage rate. And then you lower your expenses and you increase your cash flow, right? So things are moving in very, very favorable directions for investors right now. And people that are waiting to buy are missing out. So with that, I want to bring this to a conclusion here and make you a very special offer. As I mentioned, I've been part of the Think Realty community for many, many, many years now. We have helped a lot of people from this community buy their rental properties, build their portfolios over time, diversify across markets, and we would love to do the same with you as well if you're interested. So I'd like to offer you a free video consultation with Maverick Investor Group to get to know you, answer your questions, understand your personal buying criteria, your personal real estate investing goals, and help you to meet them, to develop a plan to meet them. So we work with all of our clients individually, one-on-one, highly specialized, customized basis. We are about long-term business relationships and helping our clients build their wealth through real estate, through building a portfolio of cash flowing rental properties over time. And we would love to be able to at least have a conversation with you, get your questions answered, and see if that is a good fit to work with you. That consultation you can get totally for free, maverickinvestorgroup.com/thinkrealty. So this is for this community. And we are super, super excited to meet you and to work with you and to support you. And it never costs any money to work with us. Okay. It is entirely free. So I want to encourage you to take us up on that offer. We can at least have a conversation, get your questions answered, and hopefully deliver value to you on the consult. And then if it is a good fit to move forward, super happy to work with you. So with that, I will bring this to a conclusion. And Kurt, if you're there, I'll turn it back over to you.
That was good stuff, man. Really great stuff.
I think you're muted.
Oh, can you hear me?
Yes.
Okay, that's a great stuff on there. I had some key takeaways and I love these because I get the opportunity to learn as well. Even though I've been in the business for a while, you can never stop learning, and I'm proof of that. Would not have guessed that your case study would have been in St. Louis, Missouri. I mean, I'm from the Midwest. I lived in Kansas City for 11 years. I went to school in St. Louis. I interned in St. Louis. I love St. Louis. St. Louis gets so much negative pub. One or two of the murder capital of the U.S. Population's decreasing over the years. It's still advantageous to a real estate investor, though, and it's one of those.
It was literally our most popular market of 2022. I had one client, Kurt, that closed on 10 St. Louis properties himself just in 2022.
It's incredible. I mean, and it just shows that there's an adage I learned a long time ago when we talked about markets. It's like, well, God, I would never live there. Well, just because you wouldn't doesn't mean somebody else wouldn't. You got to take that element of the personal out of it and understand that you're making a business decision. So it's incredible to me to see the list that you had on there. that St. Louis of all the markets was number one.
Yeah, and we have a number of markets too. I mean, by the way, Indianapolis, you mentioned that's also a popular market, right? Kansas City, also a good market. But these types of markets, right? Like these metro area markets that have lower than average unemployment, they have job growth, they have lower than average cost of living. These are the types of recession resilient markets, and you can just see it in the data. So absolutely, as far as real estate investors are concerned, like this is the whole idea, right? This is the whole model. Live wherever you want to or need to for your job and your family, right? But by all means, you want to live in California, you want to live in New York City, you want to live in Miami, you live wherever you want, like do that, like great, but you shouldn't be restricted to buy properties in Manhattan just because you live in Manhattan. Like you can
make
live
money
in Manhattan
anywhere, right?
And buy in the best markets as an investment. That's exactly right.
Right. And I like the phrase, I'm a fan of it, recession resilient, recession resistant. You never want to say something's recession proof for obvious reasons. What other asset classes? I know we're talking turnkey, but I mean, if somebody is a commercial investor, what generalities do you see in turnkey versus other asset classes, and what maybe are you not as bullish on as asset classes?
Man, I mean, commercials real estate, I mean, and depending on what we're talking about with commercial real estate, right? Like there's a lot of different subclasses within that, right? But certainly, retail has been taking a big hit as all these people realize they can sell their stuff online and reduce their expenses, and people like to shop online primarily now, right? Office space, boy, that's taking a big hit on what's around the other side of the pandemic. And everybody realized, gee, I can work remotely now. And actually, I'd prefer to do that. And companies are realizing, wow, these people can work remotely. And now I can reduce my overhead by not having the office space, right? So depending on what type of real estate we're talking about, I will say in terms of like, if we're talking about residential, some of the benefits of buying single family rentals as opposed to say an apartment building is number one, they tend to appreciate better. Number two, you have a retail exit strategy. When you're ready to sell, you can sell it to an end user that's going to actually be an owner occupant, and you can sell it on the retail market. Whereas an apartment, you need to sell it to another investor. You don't want a good deal, a discount, all of that kind of stuff. And, if you own 10 single family homes versus a 10 unit apartment building, you can diversify those 10 single family homes. You can buy them in different markets, whereas your apartment building is going to be in one place. And you can have a segmented liquidation strategy. Let's say of those 10 homes, one or two of them is really not performing very well. Well, you can prune your portfolio and you can just sell off those two, keep the other 8, or one or two of them skyrocket in value. Well, you can sell those two, take a profit, and, buy some more. Whereas an apartment building, all you can do is either hold it or sell it, and it's in one place, and that's that, right? So there's a lot more latitude, a lot more agility, a lot more diversification, and upside potential and exit strategy, that I think is there for you with the single families, which is why we focus on it. That's not to knock all commercial, whatever. Certainly there's all kinds of good commercial deals, and I know plenty of people that do it and that do it well, and there's a lot of great value there and all that kind of stuff. So I'm not knocking it entirely, but in terms of our niche and why we specialize there and why our clients like it, those are some of the main reasons.
Gotcha. Totally makes sense. And we talk a lot about a recession. We talk a lot about a crash, and you illustrated perfectly why not only you, me, most of us in the industry, we don't see it coming for a variety of reasons. Beyond just the sensationalism of clicks and selling media, why do you think so many people are concerned that there's a crash when the data does not suggest that there will be? Is it just the sensationalism of media, or are we missing something? Because it's almost unanimous in our business, in our industry, guys, there's not going to be a crash. We're not going to have 2008 all over again, but people are so scared of that. Why do you think that is?
I think a few reasons. One, they've seen everything else crash. They've seen stocks, they've seen bonds, they've seen crypto. They've seen everything else crash except real estate, right? So like, it's got to be coming. It's got to be coming. It's got to be coming. Everything's crashing, right? Doesn't everything have to crash, right? So that's one reason. The other reason is I think people are aware that real estate goes in cycles, which is true. And they saw 08 and 09 and what happened there. I think but I think a lot of people that aren't in the real estate space don't fully understand why today is so different from '08 and '09. Like if you're into like cryptocurrency, right? I mean, and you're looking at the 80% crash in the crypto market that happened over the last year, and you're like, oh, well, the same thing happened in 2018 in the crypto market, and you see these historical kind of like trends and things repeating each other and whatever, right? And people are like, oh, well, maybe that'll happen in real estate. It'll be like '08, '09, but they don't understand how fundamentally different things are today. With regard to things like what we're talking about the mortgages are performing. These are actually qualified buyers. They're not getting 100% financing. They actually have equity in their homes. They're not distressed. There's not a foreclosure crisis on the horizon because none of these factors are there, which were all there in '08, '09. Highly unqualified buyers buying these mortgages at 100% financing, underwater, not able to pay, not able to sell, forced into foreclosure. Like there was this whole thing that happened, which is simply not there today. And so that's why it's important to unpack this data so that you can make smart decisions, not based on speculation, but what the actual data is telling you.
A fact, right. To me, it would inspire people who aren't in the game to get off the sidelines and get into the game now that they can understand that. Question from the anonymous attendee. I wish I knew who you were, but you're anonymous. Does Maverick have a selection of banks, lenders that will fund deals for your clients? And what are the key requirements of most lenders for lending on rentals?
Absolutely. We have preferred lenders that specialize in doing rental properties, right? So these are totally separate vendors from us. We don't get any referral fee kickbacks or anything from them. We just refer clients, and there's multiple lenders so you can choose, but we do have relationships that we have built specifically with lenders that specialize in doing rental properties. And you always want to work with a niche specialist, right? If you go to a real estate agent who sells almost entirely primary homes to people that want to live there, and you're like, hey, can you help me buy a rental property? Of course, they're going to be like, yeah, but like, is that really the person you want to be helping you buy the right rental property? Same is true with mortgages. You want to work with people that specialize in doing loans for rental properties. And we have those relationships with those lenders. What we'll do is introduce you to them, and then we will let you qualify with them directly. So typically what our clients are doing, they're qualifying with those lenders. They're getting a 80% mortgage. So they're putting 20% down on single family rental properties. If it's a 2 to 4 unit property, it's typically 25% down, and then getting a 75% mortgage. So each individual person, we like you to be able to qualify directly with the lender, and then they'll be able to give you quotes on like, or good faith estimates on like closing costs and like what your mortgage payment would be and like all that kind of stuff. So we're happy to introduce you to those lenders at no cost, again, for free. Working with us is always free. And you can just go to maverickinvestorgroup.com/thinkrealty, sign up for that consult. At the end of that consult, we will make all the introductions, including to the lender that you need. No problem at all.
Perfect. Todd has a question. Who owns these properties before you come into play and they are rehabbed? In your St. Louis example, the person that owns it before you buy it for say $40K will put $40K to rehab it, and then you paid $102K. So they make money on the flip. That's the question he has.
Yes. So Todd, yes. So what we do, and let me clarify this even further in terms of Maverick Investor Group and who we are, what our role is, and all of that, as well as how we make money in the process, because that I think is really important as well. So let me explain the whole business model. I'll break it down. We are a real estate brokerage. Okay. And so the reason that that you don't need to pay any money to work with us, because in the United States, the seller pays 100% of the real estate brokerage fees. The buyer pays nothing. Okay. So we are a real estate brokerage. We are not representing either party in the transaction. So we're not representing the buyer or the seller. Okay. But we get what's called a broker referral fee for every single closing. And one of the reasons we set up our business model that way is because it puts us to deliver value. So we work with you for free. We do a consult with you for free. We introduce you to lenders. We provide you free resources. We provide you all this stuff. We introduce you to deals and buying opportunities and support you through your evaluation of them. And only if we can help you to identify a property that meets all your criteria, goes through all your due diligence, and you end up closing, only then do we make any money at all. but not by you, right? We get paid 100% by the seller because they pay the referral fees, right? And they're happy to pay us that referral fee because then they don't have to pay money on advertising and marketing and all the other kind of stuff, right? Because buyer. So for them, it's the same thing. But if we can't help you to do that, then money at all, right? And so that puts the onus on us to deliver upfront value. Otherwise, we don't make any money. And so this is how the business model, benefits our clients. Also, it's the same thing with regard to markets, right? Like, I don't care if you buy in St. Louis, or if you want to buy in Indiana, or if you want to buy in Kansas City or Baltimore or somewhere else. It doesn't matter to me. I'm going to make a referral fee no matter where you buy. So we are basically market agnostic. We want to provide you with information so that you can make the best decision for you. We want to understand your buying criteria and help to direct you and provide you opportunities that will meet your personal buying criteria. But it doesn't matter to me where you end up buying, right? And that's very different from a normal agent, a normal real estate brokerage, a normal home builder that wants you to buy their product in their market and their thing, right? So we built that business model to change the incentive structure of real estate so we could put our clients' interest first. And so to get back to your question, though, about how are these properties sourced? Absolutely. What we do is we build relationships with professional companies in these markets. So in St. Louis, for example, we have a relationship with a professional company. They are independently capitalized, multi-million-dollar professional real estate company. They acquire distressed properties, exactly what you described, with their own money. They pay cash for those properties. And then they put their own cash in to renovate those properties. And then they lease those properties out and stabilize them. And then they offer those properties for sale as an off-market private buying opportunity through Maverick to our clients, right? And they are absolutely making a profit on that. That's how they make money. And then they're paying Maverick a referral fee for the client that closed. And then you come in and you get all the benefits that we discussed, which is you're not the one that has to take all that risk of stabilizing that property, right? If the renovation budget goes over, you're not absorbing that. Somebody else is eating that. If it takes longer to complete the renovation, you're not absorbing that holding cost. If it takes longer to place that tenant, you're not absorbing that vacancy rate. Somebody else is taking all that risk and stabilizing the property, and they are getting a profit for that. And then that's how the whole thing works, right? But you're coming in, you're appraising the property, you're making sure that you're not paying over market value for it. You're making sure that you're happy with the cash flow, with the cap rate, with all that kind of stuff. And you mitigate your upfront risk by doing it that way, right? So that's how the model works. So hopefully that's clear and thorough.
Condensed version is potentially everybody wins. And that's the way.
Yeah, I mean, we certainly think so, and our clients certainly think so. So,
agreed. I mean, and that's the beautiful thing about this industry is that it truly comes down to your network. And sometimes people say it's not what you know, it's who you know. I think a step further, it's who's willing to say they know you. And when you have vetted those people and you can do business time and time again, and everybody's happy, everybody's growing, then that's the ultimate win. Matthew, one last thing. Please let people know how they can get a hold of you. I know we've got a lot of people that have been on here tonight, but I want to make sure that they know, as well as the offer you've given them, how can they get a hold of you guys?
Yeah, this is the absolute best way. Go to maverickinvestorgroup.com/thinkrealty. That is going to allow you to schedule a consult with us. It's going to enter your information into our system. We will then have it there. We'll be able to communicate with you. You can pick a time on the calendar whenever is convenient for you, and we can actually do that one-on-one connection, that video consultation with you, and then start that relationship if it's a good fit. But we are happy to, as I said, deliver all of this upfront value to you for free, no obligation, no money from you, none of that. We just want to build the relationship. If it's a good fit, we're happy to support you as best we can in your real estate investing journey.
I love it. Thank you so much, man. And please, everybody, take advantage of that. I mean, very seldom do you get something this legitimate at no cost to you. It's an investment in your time. It's an investment in yourself. It's an investment in really coming down to that question: what kind of life do you want to live? Let real estate be that vehicle that helps you achieve everything you've ever wanted, not just for yourself, but for your friends, your loved one, your families. Matthew, thank you so much, man. I look forward to talking to you soon. Next time I'm in the Vegas area, I'm gonna give you a call. We'll get together. Okay.
Love it. Thanks so much. Appreciate it. Have a
All
good
right.
night,
Thanks,
everybody.
everybody. Have a great night. Talk to you guys all soon. We'll see you next month.